Cryptocurrency trading is the act of buying and selling digital assets. Think of it like a digital stock market, but instead of company shares, you trade tokens like Bitcoin or Ether. These tokens represent value on a blockchain, which is basically a secure digital ledger. People from all over the world can participate in this market, and it operates 24 hours a day, 7 days a week. Unlike traditional markets, it never truly sleeps. This constant activity creates a dynamic and fast-paced environment for traders who are looking for new opportunities outside the conventional financial system. The core idea is simple: buy low and sell high. Traders analyze charts, news, and market sentiment to predict price movements. They hope to profit from the volatility of these digital assets. Even a small price change can lead to significant gains or losses. This high-risk, high-reward nature is what draws so many people in. They see a chance to be part of a new financial revolution. They are pioneers in a space that is still being built, exploring the potential of a decentralized world where finance is open to everyone. Why is there so much interest? Well, for some, it is the technology. They believe in the power of blockchain to change how we handle money and data. For others, it is the potential for high returns. Stories of early Bitcoin investors making fortunes have inspired a whole generation. The crypto market offers a level of accessibility that traditional finance often lacks. Anyone with an internet connection can start trading, breaking down barriers that have existed for decades. This promise of an open financial system is a powerful motivator. The appeal also lies in the control it offers. In the world of crypto, you can truly own your assets. You hold the keys to your digital wallet. This concept, known as self-custody, is a fundamental shift from traditional banking. You are your own bank. This responsibility is empowering, giving individuals real sovereignty over their financial lives. It's a big departure from relying on banks and brokers to manage your wealth, placing the power directly into the hands of the individual investor. DeFi stands for Decentralized Finance. It's a new financial system built on blockchain technology, and the goal of DeFi is to recreate traditional financial services without central authorities. Think of services like lending, borrowing, and trading, but instead of banks or brokerage firms, smart contracts run the show. These are self-executing contracts with the terms of the agreement directly written into code. They are the engines that power this new, automated financial world, reducing the need for human intermediaries. In DeFi trading, you use something called a decentralized exchange, or DEX. A popular example is Uniswap. On a DEX, you trade directly with other users. There's no company holding your funds or processing your trades. Instead, you connect your personal crypto wallet to the platform, and the trades are executed by smart contracts. This process is often called peer-to-peer trading. It gives you full control over your assets at all times, which is a core principle of the decentralized movement. Let's use an example. Imagine you have Ether and want to buy a token called Link. On a DEX, you would find a trading pair like ETH to Link. This pair is part of a liquidity pool. Other users have deposited their Ether and Link into this pool to facilitate trades. You connect your wallet, specify how much Ether you want to swap for Link, and approve the transaction. The smart contract automatically handles the exchange, sending the Link to your wallet and your Ether to the pool. The beauty of this system is its transparency and accessibility. All transactions are recorded on a public blockchain so anyone can verify them. There are no sign-up forms or lengthy approval processes. As long as you have a crypto wallet and some funds, you can start trading on a DEX immediately. This removes a lot of the barriers present in traditional finance. It opens up global markets to anyone, anywhere, creating a truly permissionless environment for financial activity. One common strategy is called HODLing. This term, a misspelling of hold, actually originated in an old Bitcoin forum post. It means buying a cryptocurrency and holding on to it for a long time. HODLers believe in the long-term potential of their chosen assets, and they ignore short-term price swings, both high and low. Their strategy is based on the conviction that the value will increase significantly over several years. This approach requires patience and a strong belief in the fundamental value of the technology. Another popular method is swing trading. Swing traders try to capture swings in the market over a period of days or weeks. They're not day traders making dozens of trades a day, and they're not long-term hodlers either. They use technical analysis, looking at charts and patterns to identify potential entry and exit points. For example, a swing trader might buy a token when its price breaks above a key resistance level and sell it a week later as it approaches a new peak. Day trading is a more intensive strategy. Day traders buy and sell assets within the same day, aiming to profit from small, short-term price movements. This requires a deep understanding of the market and honestly, a lot of time and focus. Day traders often use leverage to amplify their potential gains, but this also increases their risk significantly. They make many trades throughout the day, closing all their positions before the market day ends to avoid overnight risk. Arbitrage is another strategy used by savvy traders. Arbitrage involves finding price differences for the same asset on different exchanges. For example, Bitcoin might be trading for $70,000 on one exchange and $70,100 on another. An arbitrage trader would buy Bitcoin on the cheaper exchange and immediately sell it on the more expensive one. The profit is the small price difference minus any fees. This requires speed and often automated bots to execute trades faster than other market participants. One of the biggest differences is the middleman. In traditional trading, you rely on intermediaries like brokers, stock exchanges, and banks. They manage your account, execute your trades, and hold your assets. This system has layers of regulation and oversight. In DeFi, smart contracts and code replace these intermediaries. You trade directly from your own wallet on a decentralized exchange. This peer-to-peer model gives you direct control and custody of your funds, which is a major departure from the traditional system. Accessibility and operating hours also set them apart. Traditional stock markets have set trading hours, usually on weekdays. They close for weekends and holidays. DeFi markets, however, never close. They're open 24/7, 365 days a year. This allows anyone, anywhere in the world, to trade at any time. You don't need to open a brokerage account or get approval from a financial institution. All you need is an internet connection and a crypto wallet to access global liquidity pools. The assets themselves are fundamentally different. Traditional trading involves stocks, bonds, and commodities. These represent ownership in a company or a claim on a physical good. Crypto assets in DeFi are digital tokens on a blockchain. They can represent many things. Ownership in a decentralized protocol, a stable coin pegged to a currency like the US dollar, or even a unique piece of digital art known as an NFT. The innovation in what a token can represent is constantly expanding. Finally, let's consider transparency and security. In traditional finance, much of the inner workings are opaque. You trust that the institutions are handling things correctly behind the scenes. In DeFi, everything is built on a public blockchain. Every transaction is recorded and can be audited by anyone. This creates radical transparency. However, the security model is different. While the blockchain itself is secure, you are responsible for your own funds. If you lose your wallet's private keys, there is no customer service to call to get them back.